Hello and welcome to the Kidder Matthews Monthly Multifamily Update. This month, I'll be covering rent and vacancy data, information about the development pipeline, sales trends in the region, as well as some predictions for the future. Looking at our first graph covering rent analysis over the last 15 years, you can see that in the last decade, we grew rents in the region 40%, a remarkable amount. During the pandemic, we did see rents decline by about 10%, but since then, varying city by city throughout the region, we've seen them recover 5 to 15%. You can see the predictions are that we'll exceed the rent growth in the prior decade moving forward. In our next graph, focused on vacancy, you can see in recessionary periods we've seen vacancy spike up between 6 to 8% throughout the region. With a majority of our large development pipeline already absorbed, experts are predicting that vacancy rates will not rise much, maybe up to 5.25. Looking at the development pipeline, you can see that developers added 70% new units in the region between 2010 and 2022. What's phenomenal is that all of these units have been absorbed, vacancy hangs around 5%, and there's only 16% supply remaining in the pipeline. Looking forward, due to the City of Seattle making it very difficult to develop and manage apartments within the region, as well as rising hard costs, we predict a much smaller development supply in the future and an imbalance of supply and demand. Looking at supply and demand since 2012, you can see in the last decade that generally demand outstrips supply. When the pandemic hit, we had more people leaving the City of Seattle than coming to the Seattle, and we saw a rapid decline in absorption. However, in the last 12 months, we've absorbed all the units that were delivered during the pandemic, as well as the newer ones that have come online this year. Looking forward, the development pipeline, while healthy, does look somewhat small, reminding us of what we had in 2012 and 13, which led to a decade of rent growth. Looking at some historical sales trend, you can see that the volume of sales in the region peaked in 2017 after steady growth from 2010 through 2017. When sales volume peaked, it did stay at about a plateau until the pandemic. We saw a major decline in sales, which rapidly recovered in 2021 and the beginning of 2022. What's different this year is we do not anticipate a large sell-off towards the end of the year, and it will be one of our lowest sale years within the region in over a decade. Looking forward, due to a pent-up demand for investing in real estate in the region, we do anticipate that sales will pick up next year, likely sometime in the summer as rents recover as well. Looking back at historical sales, there's been a steady decline in cap rates for sales in the region, and we're clear down at a 4% cap rate right now, averaging $400 per foot. While we do predict that Seattle will remain a very in-demand market, we do think cap rates will adjust along with interest rates. We think for new construction, we'll see sales closer to 4.5 caps in the near term, and for older buildings, closer to 5 caps on actual income. Lastly, we have our key takeaways. One, people are using the R word quite a bit, recession. We're following the jobs. Where jobs go, there will be demand for apartments, and we know there's a lot of jobs to be had in this region. We do anticipate a development slowdown, which will inevitably benefit anyone that does own an apartment building, because we anticipate a supply and demand imbalance that we saw over a decade ago. While we've already seen the early innings of this, we do anticipate a continued slowdown of sales volume, but we think pricing will remain within 10% of where the prior peak was. All eyes towards the future. We do see headwinds ahead and just attracting talent. If we can attract the best talent to our best companies in the region, we'll see continued growth in the years to come.